Talk 1370 Retirement Journey with Justin Fort, where it's all about planning for the happy and successful retirement you deserve. Welcome to our new show, more efficient and user-friendly. You'll get more usable information in less time, nuggets of retirement planning wisdom you can act on today for a brighter tomorrow. First, you have to know this show is different from any other retirement planning show you'll hear. Why? Because I'm different. I'm Justin Fort of Fort Wealth Management, and I'm a certified financial planning professional, a chartered financial consultant, and a retirement income certified professional with a fiduciary duty to put your interests ahead of my own. What does all that mean exactly? Well, first, as a certified financial planning professional, I'm trained to work in all 5 aspects of your financial plan. Number 1, making your money grow so inflation doesn't eat your lunch. Number 2, planning for lifetime income for you and your spouse. Number 3, ensuring your liquidity so you're ready for emergencies and opportunities. Number 4, shielding you against calamity so you're not wiped out by the unexpected. And number 5, leaving a financial legacy to the people and causes you love. But what about that fiduciary duty part? The word fiduciary has been in the news a lot lately. Most people know it refers to a financial professional who is required by law to put your interests ahead of their own. That's a good thing, but that's not enough. Yes, you want a fiduciary on your side, but you also want that person to be trained to handle all 5 aspects of the areas I just named: growth, income, liquidity, shielding against calamity, and leaving a legacy. Just saying you're a fiduciary isn't enough if all you can do is sell insurance or sell stocks. That's why more and more people are coming to Fort Wealth Management, and we'd love to help you too. Don't leave yourself exposed. Call now, Fort Wealth Management, 1-800-886-5624. We'll do a free, no obligation, 5-point review measuring what you have in place now against what we know you'll need in the future. Within 1 hour, you'll not only know your likelihood of retirement success, but you'll also know what you need to do to close the gap in all of those 5 areas. Coming up today, we'll be talking about how Congress is set to make some popular tax breaks permanent, how you as a retiree can benefit from the Fed's historic interest rate move. We'll go over a month-by-month guide to wise money moves for 2016, and we'll talk about today's hottest topics, Social Security. So let's get started. Congress set to make popular tax breaks permanent. This comes from an article from Investment News by Mark Schaaf, dated December 16th, 2015. Advisors were pleasantly surprised by the tax package that will provide them more certainty when planning long-term for clients. I know I will. Congress is on the verge of giving financial advisors something for which they've been longing: certainty in the tax code. Late Tuesday night, December 15th, the House and Senate tax writing committees released a package of tax breaks for individuals and businesses. The measure would secure in the tax code many so-called extenders that have had to be renewed each year, often after expiring. Among the 22 extenders that will become enshrined in one that allows tax-free distributions from individual retirement accounts to charitable organizations. You can give without paying taxes from your IRA. Another individual tax that will be extended indefinitely allows for the deduction of state and local sales taxes. Good thing we don't have state taxes here in Texas. These permanent provisions allow taxpayers to make informed decisions about their income, giving, and tax planning generally, said Susan Scheer, Chief Wealth Planner and Tax Strategist at Northern Trust Company. It allows the planner to provide options to clients with a greater degree of certainty and lead time, and that provides the client greater flexibility in actually implementing the recommendations. Also, small business tax deductions that would become permanent include a research and development tax credit and another for capital investments. Another 34 tax extenders were extended through 2016 or 2019. In addition, the legislation makes changes to tax policy related to 529 college savings plans, real estate investment trusts, and other areas. This is the interesting part. Advisors were pleasantly surprised by the tax package, which would cost $622 billion over 10 years, according to the Congressional Joint Committee on Taxation. What's interesting about that? Well, what's interesting is that the Congressional Joint Committee on Taxation sees less taxation, less of your money coming to them as a cost. Maybe we ought to rethink how our government sees our taxes. If we're paying less in taxes for them, it's a cost. That just boggles the mind. Most of the extenders were looking for permanency on we now have, which is a good thing. This is according to Tim Steffen, Director of Financial Planning at Robert W. Baird. So if this legislation is approved, this could be a big boon for financial planners. We'll actually be able to do tax planning ahead of time regarding issues usually dependent on the extensions rather than waiting until the end of the year. And that is such a pain. Better to know. So what does this all mean to you? Well, two things. First, tax planning is important. Remember, the 5 areas of financial and retirement planning: growth, income, liquidity, shielding against calamity, and leaving a legacy. Tax planning falls into all 5 of those areas. We have to be concerned and understand how taxes will impact those 5 pillars. Well, if you're doing it right, it's in all 5. Without active tax planning, your growth gets eroded, and so does your income. Liquidity suffers because too many dollars are going to taxes. Without proper tax planning, your shield against calamity may be too small because that's all that you can afford. And when it comes to legacy planning, do you want to deliver a rich, full legacy or deliver a bitterness because you passed on a poison pill of tax liabilities to your heirs, your favorite charity? Second, if I'm the only one talking with you about how tax issues impact all 5 areas of your financial planning, then you may want to talk with me in person. So I would encourage you to give us a call now. Fort Wealth Management is a company that I own and operate. You will actually be able to sit down with myself. If you call 1-800-886-5624, I'd be happy to sit down with you for a free, no obligation, 5-point review. Let's see where you sit. Let's see where you stand. And we'll measure what you have in place now against what we know you'll likely need. Within 1 hour, you'll not only know your likelihood of retirement success, you'll know what you need to do to close the gaps in all 5 areas. In fact, if you're not hearing about the impact of taxes on all 5 of your planning areas, it's very likely you'll walk away from that hour with myself knowing more than your current financial advisor knows about your situation. So call now, Fort Wealth Management, 1-800-886-5624. Coming up next, how will you, as a retiree, benefit from the Fed's interest rate increase? I want you to stay tuned. We're going to touch on that. And of course, this is Justin Fort. You're listening to Retirement Journey with Justin Fort, only on Talk 1370. When you go in for dental work, you don't have to wonder about things like anesthesia, sterile equipment, and expertise. They're givens. Your dentist has a medical duty to take care of you. As a certified financial planning professional, I have a fiduciary duty to take care of you. You don't have to wonder if your retirement can survive a bad illness. It's in the plan. You don't have to wonder about hidden fees or unnecessary taxes or a dozen other variables because I have a fiduciary responsibility to do what's best for you, and I'm trained to do it. If you're wondering about any of these things, you don't have a real plan, and that could destroy your retirement. Call now, Fort Wealth Management, 800-886-5624. Spend an hour with me, Justin Fort. See the science behind real planning. See how you could have a great retirement. Call now, Fort Wealth Management, 800-886-5624. If you're just tuning in, you're listening to Retirement Journey with Justin Fort, where it's all about planning for the happy and successful retirement you deserve. Now, it looks like we've got interest rate increases on the way. We've seen some already. And what is that going to mean to you? And what are those interest rates increases? Retirees to benefit from Fed's historic rate move. This is a piece from Greg Lucursi. Probably butchered his name there, but this is from Investment News, dated December 16th, 2015. Higher yield on bonds and CDs, higher annuity payouts will provide tailwind to retirees. The Federal Reserve's decision to raise its benchmark interest rate, its first hike in almost a decade, that's a long time, will signal a victory of sorts for retirees over the long term as rates eventually climb to more normal levels, whatever that means. Of course, there are several factors aside from just the Fed raising or lowering rates, such as inflationary pressure on the long term. But generally speaking, one large benefit of higher rates in the future is higher yield on conservative investments retirees typically hold, allowing them to take less risk to achieve equivalent or greater yield, advisors say, and I say. It depends on what really happens, but if we get a succession of rate hikes where the Fed starts to move up back to 2006 or 2007 levels, obviously it means retirees' cash, safe money will earn more. If they're going to lock in a new annuity, they'll get a higher rate, according to Lisa Kirchenbauer, president of Omega Wealth Management. So it's an end of an era. If a retiree's financial plan assumes a particular rate of return and uses a particular portfolio to achieve that, higher rates means bonds can contribute more toward that goal versus having to take more risk in the stock market to be successful. There's a lot of opportunity, I think, if we start moving in that direction, but you want to make sure that you're invested the right way to maximize your outlook and your returns in your portfolio. As we know, interest rates will be continuing to go up. The Fed boosted interest rates for the first time in almost a decade, ending this era of rock bottom rates, which is painful for many. The Fed unanimously voted to raise its benchmark interest rate by 25 basis points, or that's 0.25%. Not a lot, it seems, but that is going to make a difference. And indicated that it would hike by about 1% point a year over the next few years. Since the end of 2008, the Fed has kept its benchmark interest rate at a range between 0 and 0.25% due to the pressures of the economic downturn that in turn drove down returns investors could get on vehicles such as bonds, money market funds, and CDs, which arguably has an outsized effect on retirees as they generally hold more assets in these conservative investments when compared to younger investors. So what does this mean to you? Well, you'll notice the constant drumbeat here is that you'll be getting better rates on your safe money. Now, safe money is a good thing. It's not the only thing, but it is a good thing. As such, it is always part of your plan when you come to Fort Wealth Management. Remember, the whole plan has 5 parts. 5 pillars, if you will: growth, income, liquidity, shielding against calamity, and leaving a legacy. Of course, if you're not planning on leaving a financial legacy, you can get by with just 4 pillars, right? Have you seen the bumper sticker, "I'm spending all my grandkids' retirement"? That is an option. But to have all your options open, you have to make sure that you have all of the other 4 pillars in place, and they have to be strong. So is this interest rate hike good news for you? Let's see how it impacts the 5 pillars. Growth. Maybe not a direct impact, because unless you're blurring the lines between, say, growth, income, liquidity, and shielding against calamity, because if you have to dip into your growth money to make up for a lack of income, then you're killing your future growth. See, take money out of the growth accounts because you need it for income or liquidity, and that money is gone. You can't have growth on the money if it's gone. You've already spent it. Let's talk about income. There is where many people go with their safe money. The question is it always interest rate sensitive? Well, sometimes it is, sometimes it's not. It depends. As a fiduciary who is trained and educated to make sure you're getting the best deal on your safe money and income options, I can show you more options than the advisors out there who can only sell you stocks, bonds, mutual funds, or annuities alone. I've got all the options in my toolbox, so I simply choose the most cost-efficient one that meets your plan most appropriately, your best interest first. So now, can you see where interest rates might impact liquidity or help you shield against calamity and the possibility of leaving a legacy, right? All 5 areas are important. So how will rising interest rates impact your plan? Has your current investor talked with you about that? Maybe a good conversation to have. You may not even have a current advisor. Maybe you think that you don't have enough money to have your own financial advisor. I want to blow that myth up right now. If you're an active saver, say you have a 401k or even a couple of 401ks, maybe an IRA, maybe a Roth, Or maybe your spouse has a retirement account. They don't have to be big accounts. You still want to plan because it's all about making sure all your assets are working together to your benefit, right? Or maybe you've just been told that since you have a 401k plan, that you already have a retirement plan. Let me clarify that for you. A 401k plan is only a plan in the sense that you have a regular savings plan. It might include some aspects of planning, such as having target date funds, but how will it convert to income? What is the exact amount of your retirement check and not if the stock market yields 8% between now and target date? You can't count on that. So with your 401k plan, you don't even know what your paycheck will look like in retirement. That's just one of the 5 pillars that we have to cover. If you're just working with your money to achieve one job, like say growth, for example, when you retire, it really has 5 jobs: growth, income, liquidity. It's got to shield you from calamity, and you may want to leave some money behind, leave a legacy. Did you know that by investing just an hour of your time with me, you can have clarity? Not only that, you'll know what you need to do to get where you need to be. Why not do it? I promise I don't bite, and I'll be honest and transparent. You can call now, set up an appointment with me, Justin Fort, at Fort Wealth Management. The number again is 1-800-886-5624. I would love to visit with you and see where you are, see how I can help. We'll start with a free, no obligation 5-point review, measuring what you have in place now against what we know you'll need. Learn where you stand, learn how to close the gap in all 5 of your areas. Call now, Fort Wealth Management, 1-800-886-5624. Next, we'll be running down a year's worth of wise money moves from our friends at AARP. You're going to want to stay tuned for that. Again, this is Justin Fort. You're listening to Retirement Journey with Justin Fort, only on Talk 1370. Hi, Justin Fort, host of Retirement Journey right here on 1370. On my show, I seldom focus on quote-unquote safe money. Why? Because when you're doing a comprehensive retirement plan for a great retirement, safe money is just not that tough to work in. If you think about it, there are really only 5 options: cash, CDs, treasuries, fixed annuities, and fixed indexed annuities. They're all safe because they're all insured, so we pick the best, buy, and move on. As a fiduciary, I know that there's much more to a comprehensive retirement plan than just the safe money part. If all your current advisor wants to talk about is safe money, then they're not thinking of the big picture. And real planning always looks at the big picture. Get a real retirement plan from a trained fiduciary. Call me, Justin Fort, at Fort Wealth Management, 800-886-5624. That's 800-886-5624. Welcome back to Retirement Journey with Justin Fort, where it's all about planning for the happy and successful retirement you deserve. Let's take a quick look at a year's worth of wise money moves from our friends at AARP. Okay, January. They say, file ASAP. The earlier you file your tax return, the less likely a thief will beat you to the punch, claiming a refund using your stolen Social Security number. One of my counterparts in Maryland says 3 clients filed late last tax season and found out they were victims when the IRS rejected their returns. Why? Someone had already filed using their information. Don't let that happen to you. File early. How about February? Prep for bigger payments. If you're among the millions who took out a home equity line of credit before the housing bust, your monthly payment could soon jump by hundreds of dollars. That's because these loans usually allow interest-only payments for the first 10 years, then require borrowers to begin repaying principal too. About $50 billion in loans will enter this phase in 2016, more than double the amount in 2014. Compounding the problem, variable interest rates on these loans will likely rise each time the Federal Reserve boosts rates, and we know that is happening. March, convert to a Roth. Investments are down. Consider taking advantage of falling stock prices to transfer some shares from a traditional IRA into a tax-friendly Roth IRA. You'll owe ordinary income tax on the value of the transferred shares, and don't forget you have until April 15th to make an IRA contribution for 2015. If you're 50 or older, you can contribute up to $6,500 annually to an IRA. Also, If you have the cash, why not make your contribution for 2016 at the same time? The sooner the money is invested, the bigger your nest egg will eventually be. April, fund a health savings account. So if you don't have one of these, it may be something you want to have. More employers offer a high deductible health plan combined with this savings account, and you have until April 15th to contribute to one for 2015. Individuals can invest $3,350 pre-tax plus another $1,000 if age 55 and up in that account, where it can be withdrawn tax-free to pay medical expenses, and we know you may need it. Okay, May, build an emergency fund. I hope you already have one, but if you don't, you need to build one. By now, you know about setting aside 3 to 6 months worth of living expenses to pay for unexpected expenses. It's basic financial planning, yet many people still don't do this. Nearly 1 out of 5 Americans age 50 to 64 rated their retirement savings in the past year to pay for an emergency, according to Bankrate.com, a website that tracks savings products. So let's make sure that our emergency money is up to snuff. And of course, at Fort Wealth Management, we plan for all 5 pillars of your successful retirement. And liquidity is important because it protects those other pillars. And so that's automatically included when we work together. Remember, you can call us at 1-800-886-5624. Happy to sit down with you. Let's fast forward to June now. Check those fees. How much of your money in your 401k, IRA, and other retirement accounts is being eaten up by fees? An AARP survey found that 73% of 401k participants age 50 and older thought they didn't pay any fees and were unaware of the amount. Listen, there are fees. You got to know what they are. And this is really kind of a pet peeve of mine. I've seen it so many times. So almost nobody who comes to my office for the first time has any idea how much they're paying exactly in fees. If I could get you to do only one thing, it would be to figure out how much you're paying in fees and understand what you're getting for that. But guess what? You can't figure it out on your own. You may need some help. I mean, you could, but you got to know where to look, and you got to have the right questions to ask. And I'll do it for you in a matter of minutes. I subscribe to some of the very most highest powered software packages to keep us up to date. And I can tell you this, when you see how much you're actually paying in fees, you're going to be disappointed that the services don't match, and you may be sad or mad. Because you're not getting the whole picture from whoever is helping you now, and try asking, you may get a convoluted answer. Well, you won't get that from us, and you won't get all the answers you need from your HR manager either. So let's jump back in with July. Fix your credit card. Most cards have a variable interest rate, but if you carry a balance, look for a low fixed rate card that could save you money in the long run and hedge against future rate hikes by the Federal Reserve. Better yet, don't carry a balance. Pay them off like I do. In some cases, you can even make money by doing that. Imagine that. August, crunch your net worth. It's a simple yet critical checkup to be done every year to show you where you stand financially. To figure your net worth and add up all of the value of your assets, homes, cars, cash, retirement accounts, and other valuables and investments, and then subtract liabilities. That's like the things you own, right? Such as mortgage, auto loans, lingering student loans, credit card debts, and others. And don't forget those things that you co-signed on. You may actually end up owing those things or owning those assets. You can use online calculators. We have one at fortwm.com. That's my website there for Fort Wealth Management. You can click on tools and click on all calculators. Got some helpful stuff there. As a side note, you'll see 7 different families of calculators on Fort WM. We're kind of nerds that way. September, shop for insurance. Premiums for auto and homeowner insurance aren't determined just by risk factors. You could save thousands. And remember, we have a specialist in our office that can help you shop for these kinds of insurances, home, auto, to save you money. That's what it's all about. We want more money to go to you and your family. October, open enrollment starts October 15th and runs through December 7th. The penalty for being uninsured is steep and rising. In 2016, the penalty is the greater of 2.5% of your income, or $695 per adult and $349.50 per child. Ouch. Of course, when you do your planning with Fort Wealth Management, call us at 800-886-5624. We include advice on insurance too. November, break up with your bank. Is your bank taking you for granted, charging you for checking, paying nothing on savings? If so, maybe it's time to switch. Free checking is widely available at smaller community banks, credit unions, and online banks, and many online banks pay more than 1% on savings for little or no minimum deposits. Very interesting. Give us a call at 800-886-5624, and I will help you out over the phone. Love for you to come in, though. Even better that way. Finally, December. Sell those gift cards. About 1/4 of people who receive a gift card have yet to spend it after 1 year, according to Consumer Reports. Don't let cards go to waste. Give them away or spend them. So that's your month by month of wise money moves, courtesy of AARP. Thank you so much. Naturally, I believe one of the wisest moves you can make is to come in for a no charge, no obligation 5-point checkup on your retirement plan. When I say it's no charge and no obligation, I mean it. It's true. Just give us a call at Fort Wealth Management, 1-800-886-5624, and you'll find out how easy it is to get this done and get it done right. And you know what? There's little to no effort on your part. Just come with what you want to talk about. You'll know where you stand in all 5 areas that are crucial to have a happy and successful retirement: growth, income, liquidity, shielding against calamity, and leaving a legacy. Is your money growing enough to keep up with or ahead of inflation? How much income will you have in retirement, or how long will it last? Will your spouse get that income if you should die first, or will you get theirs? Do you have the liquidity you need in your assets to make sure you can take care of those emergencies? Are you adequately shielded against calamities like cancer, long-term care needs, doctor's bills? We know medical expenses are on the rise. And what about your financial legacy? Will you leave a nice, tasty legacy or just crumbs? It's up to you. You get to plan for that. I'll help you do either way. Call Fort Wealth Management now, 800-886-5624. Leave us a message. We'll get back to you right away. Spend an hour with me, Justin Fort, and you'll absolutely know where you stand, and it's going to take you into a path where you can understand where you need to close and where we can help you close the gap on all 5 areas. Again, that's 800-886-5624. Call now. When we come back, a quick rundown on Social Security credits and what they mean to your retirement plan. This is Justin Fort, Retirement Journey with Justin Fort, Talk 1370. Is your time worth $5,000 per hour? Here's why I ask. Securities have a good record for beating inflation, but there are many ways to own the same thing. Suppose you want energy stocks for their growth potential. There are 3 or 4 ways to go, and the fees can range from anywhere around 1% to well over 5%. As a fiduciary, I'm required by law to do the best thing for you, not me. I can't tell you how many times people come in with investments that are so costly, I wouldn't even be allowed to offer them to my clients. In many cases, the funds that people have, they're paying 8-10 times as much as necessary to actually own the underlying asset class. And so you may be able to save $5,000 a year by simply coming in and visiting with me for 1 hour. Are you being taken advantage of? Call me, Justin Fort, at Fort Wealth Management, 800-886-5624. In 1 hour, you could possibly put thousands of dollars back into your pocket, 800-886-5624. Welcome back to Retirement Journey with Justin Fort, where it's all about planning for the happy and successful retirement you deserve. Let's talk about Social Security credits. In other words, how do you earn the credits you need to get the Social Security payments you want and need? Now, this is by no means a complete review, but we're going to hit the high points, and I want to offer a tip of the hat to Stan Hidden of AARP for a fine article. All about Social Security credits. This is from September 14th, 2015 by Stan Hinden. You earn them by working, and they'll determine when you can receive benefits. What are these credits? How do you earn them? And how do you know if you've qualified for Social Security benefits? Basically, Social Security credits are accounting units that you earn when you work and pay Social Security taxes. You can earn up to 4 a year. Each credit you have to earn in 2015 at least $1,220 of taxable wages. How many credits do you need for retirement? Well, that's 40, or equivalent of 10 years worth of work. How many credits do you need to qualify for disability benefits? It depends on your age, when you become disabled. For instance, a person disabled before age 24 may qualify if he or she has 6 credits in the 3-year period ending when the disability started, but someone suffers disability at age 31 or older, they need to have at least 20 credits in the 10 years before the disability occurred. So there's some complexity to Social Security, no surprise. How many credits are needed for my family to qualify for survivor benefits? Again, it depends on your age when you die. The younger you are, the fewer credits you need, and we can help you figure that out. Do credits affect Medicare eligibility? Yes. They're an important part of the formula that determines whether you can sign up. Generally speaking, if you're turned 65 and have at least 40 credits, you qualify for Medicare. What happens to the credits you've earned if you change jobs or stop working for a while? Well, nothing. Credits remain on your record at Social Security. When you return to work, you can add more credits. You said that to earn credits, you have to earn a certain level of wages. So what do I mean by that? Well, Social Security defines them as all payments for services you perform for your employer, wages including bonuses, commissions, fees, vacation pay, and severance pay. In some cases, tips, loans, and vacation pay may also count. What if you're self-employed? Generally, your net earnings, your gross income minus your expenses are counted as the equivalent of wages. Finally, what are the quarters of coverage? Before 1978, employers reported your earnings to Social Security every 3 months, and credits were called quarters of coverage, or QCs. But in 1978, the rules changed. Employers began reporting your earnings to the IRS and Social Security once a year. So, Social Security benefits, have recently changed, and rules have changed, eliminating some advantageous claiming options. You may be tempted to omit Social Security from your planning, but that would definitely be a big mistake. What you have to understand is that your Social Security benefits are an important part of your overall financial picture. When and how you take benefits will send ripples through your entire plan, I promise you. Has your retirement planner discussed your Social Security options with you? Or do they know how much you're going to get, how you should file? Did you know how much you take from your qualified plans at different times, i.e. 401ks, IRAs? How does all this work together? And, Social Security claiming strategies, all of this can have a dramatic impact on the taxes you pay as well. At Fort Wealth Management, we're big picture thinkers. When you work with us, we automatically walk you through Social Security options. We want you to optimize what you get from Social Security, which may or may not be the same as maximizing it. It's a complicated topic. The difference between doing it right and doing it wrong could mean tens or even hundreds of thousands of dollars of lost income over your retirement years. On top of that, the tax implications, portfolio growth, liquidity, and inheritance implications are profound. Do you want help crafting the best plan for you? Well, as a certified financial planning professional with a fiduciary duty to do what's best for you, I can help. It's what I do day in and day out. Call me, Justin Fort, at 1-800-886-5624. Again, it's a free, no charge, no obligation review of your retirement plan. You can't afford to not have it done. Let me know how you plan to take your Social Security, and we'll talk to you about how that may or may not impact every one of your 5 areas of your retirement plan. And don't worry, you don't have to be a genius. You don't have to be a millionaire either. At Fort Wealth Management, we work with people from every level because our aim is that you should have your best retirement. Call us again at 800-886-5624. Get the most out of your Social Security and how it works with your other investments. Don't leave money on the table. That's 800-886-5624. Remember, retirement planning doesn't have to be painful. The retirement you plan for, though, should be the best, happiest, and most successful years of your life. During your working and savings years, your money has only one job: to grow. In retirement years, your money has 5 jobs: growth, income, liquidity, shielding against calamity, and leaving a legacy. Your money will never fulfill all those jobs without a solid plan. That's what I do. So give us a call at Fort Wealth Management, 1-800-886-5624. Do it now. 1-800-886-5624. Look forward to seeing you. Again, this is Justin with Retirement Journey, Talk 1370.